Hello everyone, welcome to another video. Today we are going to talk about HKFRS 15, which is about revenue from contracts with customers. This standard was effective from 1st January 2018. I would put down the link below of this standard. This is available to everyone, so it's a public standard. I will put the link to the standard in the description box below. This video is going to be a short introduction on the standard. The standard, as you can see, is quite long. It's about 280 pages, close to 300 pages. So of course, we will not go over all 300 pages, but this one is going to be a very short introduction on HKFRS 15, and then later on we will talk about the standard in the detail in later videos. So stay tuned for more videos on this standard. So this is the contents page of the standard, where you see the objective, meeting the objective, scope of the standard, recognition, identifying contracts. So basically going over steps of revenue recognition. So this is just the content page giving you a brief outline on what this standard is actually going to cover. So let's get started with the introduction first. We will only cover the introduction in this small video. And then we will go over the standard in detail in the later videos. So first, we can look at the reasons why HKFRS 15 was issued. It's not really tested on the exam. I mean, your examiners don't ask you why HKFRS 15 was introduced, but it is kind of important to understand why it was issued. To get an overall picture, to understand the bigger picture behind the standard issue. So this is actually the main paragraph where they mention why the standard was issued. So revenue is an important number to the users of financial statement, right? So revenue, I mean, when an investor, a normal investor, buys the shares of a company, they usually look at the revenue numbers, right? So investors do look at this number. It's an important number in the financial statements to understand the financial performance and position of a company. But what was happening in previous standards is that the revenue recognition requirements, if you see the revenue recognition requirements for IFRS and US GAAP, they needed an improvement because they differed, right? There was a difference between IFRS and US GAAP. So what the standard is trying to do is basically bring these two standards together in line to improve the reporting requirement. So basically, in other words, to improve the reporting requirement of revenues, right? So that's what the standard is trying to do actually. So this was the reason why the standard has been issued, HKFRS 15. Now let's go through what this standard tells us, basically how to record revenue, right? So that's the main question: how to record revenue. To put it in simple words, that's the main question that standard is trying to answer. So you see, they have came up with a five-step model. And we will briefly talk about these 5 steps in this video, and then in the later videos, if you want, let me know in the comments down below, and then I can make detailed videos on these individual steps as well, because these steps are actually very lengthy. They are covered in the standard. You can read them on your own for better understanding, but if you want to make me a video, I'm very happy to do so. Just let me know in the comments down below. As you see, there are 5 steps. The first step is identify the contract with the customer, right? So the first step is to have a contract with a customer. What is a contract? So they've defined a contract. A contract is an agreement, right? So this agreement could be written agreement. This agreement could be written, or this agreement could be verbal, right? An agreement can take any form. So it is very important to understand that there should be an agreement. That's the first step of identifying the contract with a customer. So agreement between 2 or more parties, right? So it cannot be less than 2 parties. It has to be a company and a customer, right? So it's going to be 2 or more parties that creates enforceable rights and obligations, right? So the contract will create rights and obligations. That's another important key term over there. So these are all these key terms that you must use in the exam when answering the question on HKFRS 15. The requirements of HKFRS 15 apply to each contract, right? So there could be, which basically means there could be one or more contracts, right? There could be one or more contracts that has been agreed upon with a customer and meets specified criteria. In some cases, HKFRS 15 requires an entity to combine contracts and account them as one contract, right? So this is again possible, right? So companies can enter into multiple contracts with the same company, or customer, right? So they can actually combine, companies can actually combine them in one contract. HKFRS 15 also provides requirements for the accounting for contract modifications, right? So the standard also provides how to account for changes in the contract. So contract modification basically means changes in the contract, right? Contract modification will mean changes in the contract. So these changes in the contract are also covered in this standard. Of course, this video won't cover that, but if you want me to make a video, we will talk about that in the later videos as well. So let's look at step 2. Step 2 is identify the performance obligations in the contract, right? So what is a performance obligation? Something that a company needs to do, right? Something that a company needs to do, right? So a performance obligation in standard terms is actually a contract includes promises to transfer goods or services, right? So this is a performance obligation. This is the performance obligation, the definition of performance obligation, right? So this is definition of performance obligation. So a performance obligation is a promise. It's a promise that, you know, company will transfer a good or a service to the customer. If those goods and services are distinct, then the performance of obligations are accounted separately, right? So this is important to understand that if there could be more than one promises in the contract with your customer, right? So those performance obligations have to be distinct, and now they have also defined what do they mean by distinct. So here this is the definition. This is the definition of distinct. This is the definition of distinct. A good or service is distinct if a customer can benefit from the good or service on its own or together with other resources that are readily available to the customer, and the entity's promise to transfer the good or service to the customer is separately identifiable from other promises, right? So there are several conditions here, right? So you read this again and try to understand it. A good or service is distinct if the customer can benefit from the good or service on its own, which is readily available to the customer. And you see here they have used the word called and the entity promises to transfer the good or service to the customer. So the customer can use that product on its own or together with readily available services in the market, and the entity has promised to transfer the good or service to the customer, which is separately identifiable from other promises in the contract. So that's what a distinct good or service basically means. So now let's look at step 3. Step 3 is basically about determination of the transaction price, right? So we looked at contract, we looked at a contract, we looked at performance obligation, and now it's time to set the price, right? Set the price basically, or more like determine the price, to be correct. Determine the transaction price. So now you need to determine the transaction price. What is a transaction price? That's what has been defined here. A transaction price is the amount or consideration. It's the amount of consideration in a contract to which an entity expects to be entitled in exchange for transferring promised goods or services, right? So in very simple terms, if I'm providing you something, if I'm providing you a service, then I'm expected to be paid for it, right? So if, like, for example, if you're working you're working with a company, if you're an employee of a company, you are giving your resources, you're giving your time, you're giving your energy, you are giving your skills, you are doing job for the company, and in return the company is paying you for your services in terms of your salaries and wages, right? So that's what a transaction price is. So the transaction price for the job that you are doing is basically the salary or the wage that you earn on monthly basis. So that's what a transaction price is. If you go to the market and you're buying something, you pay for that good or service, right? So that is a transaction price. The transaction price can be a fixed amount of a customer consideration, but can be variable consideration as well, right? So transaction price is basically could be fixed, or it could be a variable component. And accounting for these two components is going to be different. It's going to be different. It's not going to be the same. And of course, this is probably it's covered in the standard, but this video is not going to talk about that, because this video is just about the 5 steps. Is only about 5 steps here. So the transaction price could be fixed or variable. The transaction price is also adjusted for effects of time value of money, right? So if it's a variable consideration or if it's a fixed consideration at some point in time in future, if company receives money in future, then a company needs to take care of time TVM, time value of money, right? Which includes a significant financing component and for any consideration payable to the customer, right? If the consideration is variable, an entity estimates the amount of consideration to which it will be entitled in exchange for the promised good or service. So when variables are like if your transaction price is variable, then a company will have to estimate the amount of consideration. So company will actually estimate the amount of consideration. The estimated amount of variable consideration will be included in the transaction price. So variable consideration is included in the transaction price, right? So very well, your examiners can actually test this, and they do test this in the exam. So you would have to understand this thing very well. The estimated amount of variable consideration will be included in the transaction price, right? So even if your consideration is variable, it's included in the transaction price. That's what it means, but there's a condition over there. Only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur, right? So what it is saying is that the variable consideration, which is going to be included in the transaction price, the company does not expect that it will be repaid to the customer, right? Because only then, so you remember, accounting is a very conservative. Accountants are very conservative, and accounting observes conservatism. So recognizing revenue, there's a very high threshold to be met. And if you remember, this is very similar to contingent asset. This concept is very similar to contingent assets. Company only recognizes contingent asset if it's highly probable. Otherwise, company cannot actually recognize contingent asset. So it's a very similar concept here. Companies will only include variable consideration in the transaction price if they are not expected to return that amount, right? If they are not expected to return that amount. That's what this is. So this is how companies determine transaction price. Let's look at step 4. Step 4, allocate the transaction price to performance obligations, right? So you see, if there's more than one, actually, more than one performance obligation, we'll call it PO, performance obligation, then company needs to allocate. Company needs to allocate transaction price, right? So an entity typically allocates the transaction price to each performance obligation on the basis. So they have defined the basis. Right? So they are also, the standard gives you how to allocate the transaction price. Don't assume things by yourself on when it comes to allocation of transaction price. The standard tells you how to allocate the price. So on the basis of the relative standalone price selling prices of each distinct good or service as promised in the contract. If a standalone selling price is not observable, so a standard also tells you if in case you are not able to find observable prices, then this is what you do. Then this is what you actually do. So what do they do? If it's not observable, an entity estimates it, right? So company is going to estimate it. Sometimes the transaction price includes a discount or variable amount of consideration that relates entirely to a part of the contract. The requirements specify when an entity allocates the discount or variable consideration to one or more, but all performance obligations are distinct goods or services in the contract, right? So all this is probably it's covered in this standard in the pages further in this standard, not here, but it's covered in this standard in the pages ahead. So if you want me to cover these steps in detail, let me know and I will make a separate videos on that. So let's look at step 5, which is the last step in revenue recognition. Let's look at step 5. So this deals with the timing of revenue recognition. The last step deals with the timing of revenue recognition. Revenue is recognized or as when the entity has satisfied the performance obligation. The general idea or criteria is companies can only record revenue if performance obligations are satisfied. So an entity recognizes revenue when or as it satisfies the performance obligation, right? So either when or as. So this means that when the company has satisfied, it's done. Whereas in as, it means that it's satisfied over time, right? So if you go here, this like at a point in time is basically dealing with when, and over time is basically dealing with the as part here. It satisfies performance obligation by transferring the promised goods or service, right? So how do you satisfy performance obligation? The company satisfies performance obligation by transferring the promised goods or service to the customer. So when do we satisfy? When does the company uses at a point in time? Typically, when promised transfer of goods, right? So see here, goods, right? So when companies are actually transferring goods, then it's at a point in time. If it's a service, typically speaking, if it's a service, then it's over time. So generally, if it's a good, then revenue recognized at a point in time. But if it's a service, if this is a service, then revenue recognized is over time. Now, of course, there are conditions to this as well. But they are covered in the standard ahead. So if you want me to make a video on that, please let me know in the comments section below. Thank you very much for watching this video. If you think this video was helpful to you, please give it a like. Subscribe to my channel to stay tuned for more videos on accounting standards. And I hope this video was helpful to you. Thank you very much.